Hello and welcome to this session in which we will discuss changing tax rate as it relates to tax strategy. Now, right now, for example, in the US, the corporate tax rate is set at 21%. Now, it's set at 21%. What happens if we know in the future it's going to be 24 or if it's going to be 18? Now, we don't know. Sometimes the government tells you ahead of time. Sometimes they don't. Sometimes changes happen abruptly, suddenly. But as a company, we need to be aware. We need to keep an eye on legislation to know if there's any changes in tax rate, and based on that, how should we plan? So changes in law and other external factor can modify the marginal tax rate that could apply to them. For example, a change in the administration, an economic shock could force the government to change the tax rate. So this could have a significant impact on how corporations plan their taxes. But generally speaking, when taxes are stable or expected to go down, what you have to do, you want to bring your deduction to the current period. Why? Because the lower the tax rate, the worse it is for you for the deduction. You get less benefit from your deduction. But the opposite is true for revenue. If you have revenues, if you have income, you want to push income into the future. So right now the rate is 21%. What we're saying is this: if in the future it's going to be 18%, which is lower, what should you do now? The company should take all their deduction now because the tax savings is lower, and the further income into the future because they will pay income at 18%. So this strategy helped to reduce the present value of the tax payment and to do what? To save money for the company. And this is what we will be discussing in this session: changing tax rates. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
If the tax rate are expected to rise, so notice what happened here. I changed the scenario. The value of the deduction increase since they have more taxes in high period. So if we're going to go from 21% to 25, well, let's make it 28%. Well, if that's the case, generally speaking, without taking into account the time value of money, you want to move the deduction forward because you want to take your deduction based on 28%. And the opposite is true. If you know the tax rate in the future will be 28%, you want to take your income, you want to take your taxable income now. It's the opposite. So you have to be very careful whether you are dealing with an income or a deduction situation. Earning income in years with high tax rate becomes less effective due to the increased tax burden. Now we're going to add to those, the time value factor, but this is generally speaking, assuming there's no time value factor, which is the discount rate. Therefore, in an environment where tax rates are expected to increase, what should corporation do? They might find it more beneficial to delay the deduction to future years. They might get benefit, they may not get more benefit, and to recognize the income in earlier years because the rates go up. Now again, we're not factoring yet the discount rate. What's the discount rate? The cost of money. There's a time value for the money. So the decision whether to accelerate deduction or defer income also depend on the discount rate, not only the tax rate plus you have to take into account the discount rate, which affect how future cash flow are valued in the present time. So to make the proper decision, you have to take into account the tax rate as well as the discount rate. A higher discount rate might still make it worthwhile to accelerate deduction and defer income despite rising tax rate. What does that mean? It means it all depends on the effect, the influence of the discount rate vis-a-vis the tax rate. So we have to basically do a computation to determine if it's more beneficial for us to defer an expense or take it now, or to defer an income or get it taxed on it now. So Beyond federal taxes, also we have changes in tax laws that could also significantly affect the corporation overall tax rate. So we have to look at the federal as well as the state. Therefore, a corporation needs to stay informed about potential legislative changes at both the federal and the state level that could affect their tax strategy. Now, the best way to illustrate these is to look at examples, starting with deductions. Let's assume Smith Company received an invoice for $5,000. And they received it November 15th, year 1. Payable February 15th, year 2. So Smith marginal tax rate is 21% this year and expected to be the same next year. Oh, well, I hope this will be an easy example. If it's the same, what should the company do? Should they pay the bill now, this year, or should they defer it for next year? Well, the present value for $1 for 1 year at 7%, the discount rate is 0.935. Since the invoice is for an expense, Smith aims to maximize the present value of the tax saving from the deduction. How do we find this out? We'll take the pre-tax expense times the marginal tax rate equal to the tax savings times the discount rate to figure out what's the present value of the tax. Well, if we pay it in year 1, $5,000, we're going to get 21% deduction. That's $1,050 times 1, the time value factor, because we're paying it now this year. So the savings is $1,050. Therefore, the net cost is $3,950. We're going to pay $5,000. We're going to get a tax saving and $1,050. Therefore, the net cost is $3,950. If we wait for next year, we should not, because we already know that the tax rate is the same, and we're going to get hit on the time value. So 5,000 times 21% is 1,050. We're going to discount. It's not really worth 1,050. The savings are worth $981.75 because we have to discount to the present value. Therefore, the net cost of the invoice is $4,018. We paid. Our net deduction is $981.75 because we're not gonna get the deduction until later. Therefore, our tax savings is $68.25 if we pay this year. This is assuming what? The rate is staying the same. Let's assume tax rate is rising. When the tax rate are on the rise, the deduction between deferring tax payment to save money later or paying them off immediately to save money isn't straightforward. Why? Because now you have two factors. If the tax rate is going up, that's good for the deduction. But you have to take a look. Is it worth it from a discount perspective? Is it worth to delay it? Yes, you're going to have more tax saving, but when we take the discount factor, it may not be worth it. That's why it's not straightforward, because you have to compute for the deduction. You have to take a look at your computation to determine whether the tax rate increase is worth more than the discount. This is because the benefit of delaying tax payment when rates are higher must weigh against the impact of the discount factor, which determine the current value of the future payment. To put it simply, if the tax rate are expected to go up, it might seem wise to delay the tax payment because the deduction will be worth more and we will save more money when rates are higher. However, due to the discount rate, the time value, money paid or saved in the future is worth less than today. So that's why you have to do what? Look at an example to determine whether it's a good idea or not. Green Inc. received a $15,000 invoice for an annual software licensing agreement on November 30th, year 1, with a payment due in year 2, February 28th. And Green's tax rate is 21%, but expected it to increase to 26% next year due to anticipated changes in legislation. The present value of $1 a year from now is 0.943. So what do we have to do? If we take 15,000 times 21%, our tax saving now is 3,150. 15,000 minus 3,150 equal to 11,850. So this is the net cost this year. If we defer this for next year, we're going to get a higher savings. 15,000 times 26%. The tax saving is 3,900, but that's savings for next year. If we multiply it by the time value, the tax saving compared to today is 3,677. Obviously, it's higher. The net cost is 15,000 minus the $3,677. The net cost is $11,322. In this situation, the tax saving is $527.77 if deferred, Now what we're doing is we are deferring the expense. This is against common wisdom because we want to take the expense now. The reason it's benefit because the tax rate is providing higher benefit than the discount rate. That's why you have to do the computation to find out whether you should defer an expense if tax rate going up, because you have to look at the tax rate benefit versus the negative effect of the discount rate. So under a changing tax rate, the key question becomes, does the benefit of paying less taxes outweigh the cost of money? So you have to look at those two factors, tax rate versus the time value, the discount rate. If the increase in tax rate is significant enough, it might be better to defer the tax payment despite the reduced present value. And this is what we just saw in this example. So it was worth waiting. Conversely, if the discount rate effect is strong, if the discount rate is going to reduce your money substantially, it might be better to pay or save on the taxes now, even the rate are expected to increase. So here, let's assume the discount rate was 0.8. It may not be, let's do the computation just to kind of see this. If we take 3,900 times 0.8, well, the savings will become 3,120, which is less than 3,150. So you have to look, that's why you have to look at the discount rate. So in essence, when planning for taxes in an environment of rising rate, it's crucial to balance the tax rate increases against the present value factor to make the most financially sound decision. Now let's take a look at an example that involves income rather than expenses. Income. A company expects $100,000 in pre-tax income. Remember, income are different than expenses because you have to pay taxes on those. You're not getting benefit. The current rate is 21, but it's anticipated to grow to 25%. Now you might be saying, hold on a second, if the tax rate 21 now, I should, get the income now, not defer it. True. So paying this year, your tax bill is $21,000, and that's exactly $21,000 because there's no present value factor because you're paying it now. If you defer it, you have to pay taxes of $25,000. But what you did is you defer your payment a year from now. Now let's assume there's a present value factor of 0.95. Well, even though the present value factor is 0.95, it's still you're better off paying your taxes now. But if the present value factor was low enough, let's do 0.8. Let's do a 0.8. So if we take 25,000 times 0.8, now equal to 20,000. If your factor is 0.8, it means when we discount the money, it's worth, you paid less taxes if you defer it. So for now, based on the original scenario, paying the taxes this year at a lower rate is more favorable. Although next year you're deferring your payment for a year, but it's not worth it because the tax rate offset the discount factor. Let's take a look at another example. Let's assume lower rate in future years. Well, let's assume the tax rate is expected to decrease from 21 to 18%. What should you do now? If you pay now, you pay 21%. What do you think you should do if you have income? Defer the income. You're going to get a double benefit here. The future tax rate is 18% plus the discount rate will give you another boost because you defer your payment. The present value of the payment is less. So you have to pay $18,000, assuming a discount factor of 0.95. Well, you only have to pay the present value of your payment is $17,100, which is way higher than paying it now, $21,000. Here you want to defer your income to next year. Let's take a look at this multiple choice questions from farhatlectures.com. In an uncertain tax environment, what factor must corporation consider along potential tax rate changes? So in addition to the tax rate changes, what should we take into account? Is it the inflation rate? Is it the average tax rate for prior year? That doesn't make any sense for prior year. Is it the fixed cost of capital? What does the fixed cost of capital has to do with our taxes? Nothing. So is it the discount rate or the inflation rate? Now, well, it's the discount rate, but the inflation rate, some people say, but the inflation rate influences the discount rate. So if it's higher inflation, we have a higher discount rate. Yes, but the inflation may not be affecting your own discount rate because the company has its own factor that determine their discount rate. What's your discount rate? Therefore, the answer is the discount rate. Now, the inflation rate will affect the discount rate, but many other factors beside inflation affect the discount rate. Therefore, the discount rate represent the other factor that you have to take into account when doing what? When determining whether to defer expenses or defer revenue into the future. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, additional resources that's going to help you, whether you're studying for your CPA exam, enrolled agent, accounting courses. Farhat's always here to help. Good luck, study hard, and invest in yourself.